Kind of wanted to get into your product story as well. I think you guys are unique in a lot of facets. The way you handle product, the way you think about product is certainly one of those unique and differentiating characteristics. So you kind of trace the story all the way back to 1963, which incidentally was actually the year that my granddad also got into the business. I don't know if you knew that or not.
No.
So right around the time your dad was getting in the business, my granddad was getting in the business. And so what has been your product mix over time, and how has that changed, and what does it look like today?
Well, back when Dad started and your granddad started, everybody had the same product. It was whole life, you know, and there really were no differences or no significant differences between those products. I came in to start working with Dad in 1987, and that is a point where interest rates were very, very high. I remember my wife and I's whole life, you know, and there really were no differences or no significant differences between those products. I came in to start working with Dad in 1987, and that is a point where interest rates were very, very high. I remember my wife and I were happy to get a mortgage at 10.5%. And the fact that we took out a 30-year mortgage at 10.5% meant I thought that maybe rates would go up more. So there was a lot of disruption. This is also the time really when desktop computers were coming in, so illustrations, and then projecting out, well, if the interest rates, some of these products were crediting 14%. You know, if they credit 14% forever, here's the premium you would pay, and this one's lower than this. So kind of the beginning of the ledger wars. Their companies, we were looking at the executive life and confederation life and Manulife. So this, what we see now with illustrations is an old problem. This is just a new version of the problem. Then a thing that a lot of people don't talk about, maybe some of us don't want to remember, but we had this period starting in 1991 with the failure of executive life, really running all the way through 1999 with General American having to be folded into Met. During this period, you had Confed, big companies with AAA ratings got in trouble. So there was this focus on safety and AAA companies. And the product we were selling a lot then was a whole life second to die product from Met with these during that period. So after that, it was really a move to variable, and we were early adopters. And kind of like you, I was a young guy, and I wrote this article called The Case for Variable Life that won this award. And then I got invited to speak to the CLU Institute and AALU and the Forum and $1 Million Roundtable. So that really kind of began my speaking career. And I look at you and I think that kind of was where I was at a similar point.
You caught the wave. You were on
yeah. So sometimes it's not being right, it was being at the right place.
It's a lot of it.
Yeah. So that kind of, and then after 2000, we saw our sales really shift over to GUL. So there was a period of 7 years where that kind of, and then after 2000, we saw our sales really shift over to GUL. So there was a period of 7 years where variable dropped down to maybe 20, 25% of sales. And it was who has the cheapest GUL. And really starting in about 2013, as interest rates went down, we could just see that crossover, variable life picking up more and more and more. And today, if I factor out term insurance, 83% of our life insurance commissions are our separate account so far year to date in 2020. So it's back.
Yeah, it's back with it, which is an aberration from other insurance brokerages, when you look at the stats, the VUL market is very small compared to that. You have strong opinions. So many times when I talk to people who are in a position of responsibility in our industry, whether they're producers or whether they are brokerage presidents, or whether they even work at insurance companies, they just kind of sell what's out there, and they take companies' word for it. And you kind of mentioned the days of Confed and Crown is another one, and some of the other ones that folded, and that maybe that imbued you with some skepticism for what comes out of insurance companies, some well-founded skepticism. And so I view you in some degree as a little bit of a skeptic, and you have been pretty vocal about your skepticism about IUL. So what percentage of your business is IUL, and why do you think it looks that way for a firm of your size and looks so different than your peers?
Well, we're at about 4% IUL. And as I drill into that, a lot of that is product that offers a secondary guarantee well out to 100. So it's a GUL IUL. And as I drill into that, a lot of that is product that offers a secondary guarantee well out to 100. So it's a GUL on an IUL chassis. And then a small bit of it is unfortunately policyholders who are with companies where that's the only thing they have left.
Mm.
So I think a lot of this just goes to your work. I mean, your work has really influenced me, and I understand the economics. We manage $6 billion of assets. We do a lot of hedging with protected accounts, a number of things. And I look and I say, this is what is affordable. So your work on the affordability of a cap and knowing where this is going to be, to sell IUL at anything close to AG 49 rates is a strong word. You are either purposefully telling a lie, or you haven't thought enough about this to give good advice. So it's just, I'll say it, it's wrong. And maybe as the primary shareholder of Valmark, I can say that. If I worked for an insurance company as a wholesaler, I might feel that, but I'd lose my job if I said it. So it's also a little easier to be on the distribution side of the business and say, let's really do what is in clients' best interest. Let's sell things that work for the long haul. I don't have to go out and buy matching bonds to back these products. So we really can objectively say what is going to work for the long term.